Hi, I'm Jim Jubak, and welcome to my YouTube video for, what is today, March 3rd. One of the things that I love right now is it's almost 50 degrees in New York, which brings all my thoughts to baseball. And we actually got an announcement from the Yankees and the Mets the other day that they will allow fans in the stadium 10% of capacity. No lines at the beer stand, etc. What more could you ask out of baseball? Okay, if you want more of me, you can go to my free site, jubakpicks.com. If you want even more of more, you can go to my subscription site, jubakam.com. That has more portfolios, 2 extra ones, a new portfolio long-term for millennial investors, and special reports. That is the source of some of the things I'll be talking about today. Please don't forget to like and subscribe. Okay, today's title is Best 2 Hedges for All Your Market Worries. The market isn't collapsing. It's sort of going in, because there are so many worries from day to day. So people are really afraid, people being investors and traders, are really afraid of getting too far ahead of the news. So that, for example, tomorrow we get durable orders, we get factory orders, we get initial claims for unemployment. On Friday, we get the February jobs number. You can imagine why investors and traders, yourself included, are sitting there going, well, I'm not sure I want to put any money one way or another, long or short, on this market until I get that news. So that's where we are. We're kind of trapped in that. But taking a somewhat longer term perspective, we still have a lot of ups and downs ahead of us. We've got worries about there'll be too much stimulus. We've got worries about there'll be too little stimulus. We've got worries about the recovery will be too strong, triggering the Fed to do something with interest rates and bond buying. We've got worries that the recovery won't be strong enough, which will mean that we won't get the earnings growth that's already sort of priced into the market. We're worried that interest rates will go up. We're worried that yields will go up. Yields have already started to climb. Today we're back to 1.5% yield on the 10-year Treasury. We're down as low as 1.4 after a huge climb. So that's pressing on stocks. And of course we've got the strength in the dollar today, at least. Why, God only knows, which is pressing on some of the hedges. But I think there are 2 hedges that we can talk about. Let's look at some charts. One of the standard hedges in a uncertain market is gold. And this is a chart that looks at the SPDR gold shares, GLD is the symbol, ETF. And you notice that way back in January, we were way up here, and it's pretty much been straight downhill ever since. The problem with gold right now is that gold doesn't do well when interest rates and yields are climbing, because gold doesn't pay anything. So basically you're looking at investors going, well, I really want to hedge my market, but I really want to hedge my market risk, but I'm not convinced I want to be in an asset that pays me absolutely nothing. So one alternative to this is, and that I like as a hedge in replace of gold, is copper. And this is a chart for the US Copper Index Fund, which is also a ETF, so you can trade it CPER. And you notice that unlike gold, this has been going pretty much up. It's had a little downturn here because the dollar is stronger. Copper is a commodity, so it does respond to changes in the price of the dollar. But unlike gold, copper has a lot of economic uses, so that it not only is a commodity, which therefore lets you hedge against, say, inflation or worries about inflation, but it's a commodity that will rise if the economy picks up. If there's more economic activity, you'll get more copper demand, prices will go up. So you're looking at a really, really good hedge for market risk here. The other thing I like about copper is that over the longer term, copper is playing on the adoption of solar power and the adoption of electric vehicles, because both of those are big, big uses of copper. Much more copper used in an electric vehicle than in an internal combustion engine. Year-to-date copper, the copper index, the US Copper index fund, is up about 19.5%. In 2020, it climbed 23.9%. This contrasts with GLD, which has been falling. Okay, so that's one possibility. The other possibility is a standard hedge on stock market risk is bonds. And the idea of building a portfolio is you buy some bonds that hedges against the risk of the stock market, because most of the time those two assets are not terribly correlated. That bonds go up when stocks go down and vice versa. What we're getting right now, however, is a very heavy correlation with sinking bond prices, which means yields go up, and as yields go up, stocks also go down. So it's not a very good hedge at the moment. This is a chart for an ETF that is the iShares 7 to 10 year Treasury bond ETF. IEF is the symbol. And you notice that, again, it has been down, tracking with the market. As yields have climbed, it means bond prices have gone down. Two problems with this. One is it's not a very good hedge against stocks because it's moving in the same direction as stocks. And two is that it's buying a hedge which is going to lose your money and not getting a diversification out of it is not a good set of alternatives. Okay, so what's an alternative to that? Well, one of the things one of the sectors that goes up when yields are climbing, especially when long yields are climbing, is bank stocks. And that's because banks, which you don't necessarily think of as borrowing, but they do borrow a lot of the money that they then lend out. And they borrow at the short end of the market. They borrow in the commercial paper market. They borrow at the 1 month to 3 month end of the market, where rates are relatively low. And they lend at the long end of the market. So they lend for mortgages for 10 and 30 years. So if you're looking at a big increase in yield for a 10-year or 30-year treasury, and mortgages are benchmarked against the 10-year treasury, you're looking at a situation where bank profits look to be going up because they're seeing an increase in the spread between their short-term borrowing and their long-term lending. So this is an ETF, the Invesco KBW is a long-running bank index. So it's the Invesco KBW Bank ETF. KBWB is the symbol, and you notice that unlike the bond chart I just showed you, this has been going pretty much uphill since then. So what you're looking at is here, year-to-date return from this ETF is about 19.15. In 2020, it was down about 10.36. Bank stocks didn't do very well. This is certainly much better alternative to hedge this market than, say, buying a straight bond fund. So these are two alternatives. They won't satisfy all of your worries. They won't alleviate all of your worries, all of your risk. One of the things I've been suggesting in the special report I just did is doing some selling selectively. I think you've got a window to sell now until July, which is July to September, which is when I think the Fed, if everything goes well with the recovery, the Fed may start sort of rattling its sword about cutting back on bond buying, which would then have a big effect, as we've seen over the last week or two on stock prices. So I think you've got a window now, sell into rallies on stuff that doesn't look like it's got a good upside, which for stocks means, well, if it's a growth momentum play, you don't see any real reason for growth to accelerate, or so you think the stock is priced out, or valuation has been up, or there's really something wrong with the stock and the stock's been going nowhere and you've been sort of holding it, hoping that it's going to start going somewhere. This is not a market where you really want to hold things that you're hoping for. Okay, so that's how I would hedge this market. Please, if you want more of me, more on this subject and other subjects, some portfolios, go to my free site, jubakpicks.com. Or if you want even more portfolios and the special report, you can subscribe at jubakam.com. Thanks very much. Remember to like this and to subscribe. See you next week.